Hey, this is Brent from Wolf on Wall Street Trade with a market update for the week ending February 22nd, 2019. I haven't done any videos the past couple of weeks because we've had holiday shortened trading weeks, and to be honest, the market, it's still grinding higher, it's still bullish, but I think the perception of that bullishness or the perception of what's happening is a lot greater than what is actually happening. So this is a weekly chart of the S&P 500 with a 50-week moving average. We'll come back to that. I'm going to take it off for now. So what I have is weekly candles here, and I think I'm going to call this the Flying V, the Christmas Flying V. And what I like about Japanese candlesticks is you can kind of just sit back and take a look and get a bird's eye view of what the trend is. So when we have these red filled candlesticks, that means the week opened up here at the top of the weekly range and then closed down here near the bottom. So these are bearish weeks, you know, where we see these big red candles. And now you have these big green candles, especially the first 4 weeks here, and got a little bit of slowing up here. We'll take a closer look at this. This is just an absolutely perfect, beautiful example of the concept of fear and greed in markets. So here we have fear, here we have greed, but I have to tell you, it's pretty unusual to end a week or end a day with a big red candle that closes down by the low and then have a rip-roaring up day the next day. If we look at a daily chart, you can get a better view of that. So this first leg down, consolidation. This is a whimper rally. We'll get to that. And this second leg down, and you can see it ends here at the bottom of the day. I mean, it closes that day right at the low. So you don't usually see that for a reversal. You usually see something like a little tail on the candle here, maybe a bullish hammer or something like that, or a gap down, a small doji, something like that. But you don't usually see this and then this come right after it. But I had been short all this and all this, so I was in small caps for most of this. I kept half that position through almost the end, and I picked up some Nasdaq in here and kept that. And I'll show you why I got out and kind of the idea of these extremes of fear and greed. So let me pull up QQQ. So this is QQQ with the channel, the downtrend channel, and this is exactly where I got out and why. Now QQQ are in the market, they're pretty much all moving the same at this point. Could have bounced off that, but it looked like it was going to go through it, and it did go through it. So to me, this was just an oversold extreme at this point. And now here we are back at the top and above this channel. So this is kind of the pendulum swinging from absolute fear to, okay, we feel a little bit better about the markets, now getting into like absolute greed. So you can just kind of see that on either side of this channel, here or here, and the channel of course is kind of trending down. But I think it's important to understand what's going on and why. So let's jump back to the S&P 500 and take a look at what is driving the market right now. So again, this kind of reversal is really odd. You don't see it much. And if you want to understand what happened, just go to Steve Mnuchin, the Secretary of the Treasury for the United States. Go to his Twitter site and check out his tweet from December 23rd. This is the Plunge protection team in action. And like I said, don't take my word for it. Just go to his Twitter site. Here's the tweet. Here's Steve Mnuchin, right? December 23rd. So this is on a Sunday. Okay, now the market sold off the next day, December 24th, Christmas Eve. So you can read here, he says, today I convened individual calls with the CEOs of the nation's 6 largest banks. See the attached statement. Now if you click on the attached statement, so this is the release from the Treasury Department. This was on his Twitter feed, and it starts talking about that he's called all the banks and confirmed that they have ample liquidity for lending and that there's not going to be a bank run, that things aren't falling apart. And this actually spooked the market a lot the next day, partially causing that sell-off. And if you scroll down a little bit more, and I've highlighted it here in yellow, tomorrow the Secretary will convene a call with the President's Working Group on Financial Markets. That is known as the Plunge Protection Team. It always has been. And he says, which he chairs. This includes the Board of Governors of the Federal Reserve, the Securities and Exchange Commission, Commodity Futures Trading Commission. He's also invited the Comptroller of the Currency, the FDIC Corporation head, and all these key regulators will discuss coordination efforts to assure normal market operations. So this isn't some kind of tinfoil hat conspiracy. markets were selling off horribly, right? But worse than that, I think, were credit markets absolutely shut down in December. And I think that really spooked a lot of people, including him and the Federal Reserve. So this is what happened next. We go from a market that feels like in December here, it's never going to stop selling off, right? Just keeps on going down, closes here at the low of the day, and then we get this big rip up. That's your plunge protection team in action. And then the market kind of, this is good for a decent rally, a good counter trend bounce. And then the market looks like it's going to roll over again right here. And why? This was January 3rd, and this is when Apple came out and downgraded their earnings for the first time, or pre-announced for the first time in 20 years that they weren't going to make their numbers, right? And then Apple goes ahead 3 weeks later and reports, and financial media says, oh, Apple beat their earnings on a downgrade from 3 weeks earlier. So that's a little bit crazy. In any case, the market looked like it was going to roll over here. And the point I'm getting at is in December, when crude had already lost up to 41%, that is a major sign that there's something really wrong. And you're going to see that in the economic data coming out. And that will give the Fed and Powell the cover they can use to go ahead and make that dovish pivot and kind of put rate hikes on hold. I expected that to happen at the end of January, January 30th, when the FOMC meets. I think this day we had credit markets crashing, we had bond yields flash crashing, we had currencies flash crashing. I think this really spooked the Fed, and the very next day, which was the 4th of January, Powell just makes this epic U-turn from back here hiking rates, and then 3 weeks later, everything's on hold, and the market celebrates that. So that's major catnip, and this is what I've always said for many years, and if you're a member of the site, you know this. I talk about this all the time. Counter trend rallies and bear markets are almost always started. They almost always have a catalyst in some action that the Federal Reserve takes or in some action that the government takes. So this is what we get from that. The market's kind of going up in this counter trend rally and an ascending wedge, which is a bearish price pattern, and then it starts to stall out and move sideways here. Now here we come into the actual Fed meeting on the 30th. Now remember, he went dovish back here on the 4th, well ahead of the meeting, and market's going sideways, and then he does it again. He goes dovish again. So it's just an epic pivot from the Federal Reserve. So back here he said, we're going to put rates on pause, the rate hike on pause, and see what happens. And over here he's like, well, we're going to stop everything. Balance sheet expansion. I mean, we're done. They got spooked. I mean, really spooked. And then we get a pretty decent move on that, a knee-jerk reaction, which is kind of common for the Fed going dovish. And the last couple of weeks we've been doing this trade war deal, and this is what we've been doing. So I want to show you an example. I've put up many examples from 2007, 2008 of when the market is selling off and then the Fed goes dovish. I'm going to show you a really interesting historical example from none other than 1929. This is a 2-day chart of the Dow Industrials from the early 1920s. You can see the dates here for the years, and you can see price up here. So I'm just giving you like a bird's eye perspective of this massive rally going into 29. And again, I'm just making a simple point here about the nature of markets and counter trend rallies. And I'm going to move to a daily chart, and we're going to walk forward just to see what happened. And let's zoom in a little bit. So here we are, kind of at the top of the rally, as you can see. And we're going into October. So watch. A little different price bars, but that's fine. And here we go. So we have this first leg down. It actually remarkably similar. It's like this crash pattern that I've seen time and time again, and actually happened in 2018. You get a first leg down, a little counter trend bounce or a pause, sometimes a bear flag, and a second leg down, and you get a consolidation in here, and then what I call a whimper rally, and that's right here. But that's not the point of what I'm getting at. So I'm getting at the market is just really selling off here. You can see, and I'll put up some actual dates and show you, what was going on, but the market is just selling off horribly, right? And then we get this about 5-month counter trend rally. Now, if you think the current rally is impressive, this was a 50% move from down here to up here over about 5 months, right? Now I'm going to show you what this looks like just in like a bigger picture perspective. Let's go to a weekly chart. So there it is. There's the big rally. There's the first sell-off. There's that counter trend rally. And this is kind of what happens next. So just to give you perspective, again, it's not a forecast of anything. It's just perspective on how these work. So just a massive sell-off, right? Now let's walk back. So we have the massive sell-off here, counter trend rally here. This is a weekly chart. So this is about 5 months and about a 50% move. So huge, epic counter trend rally. But what I want to show you is this part, what happened right before this. So let's jump back to a daily chart. I'm going to back it up and I'm going to put some notes on here so you get some perspective. So here we are at the high. And I've got little notes here and you'll see as we get into them. Actually, let me zoom in a little bit closer just so you can see, because I'm really trying to get the point of this. And here is the first leg down, pause, second leg down, 4 to 6 week consolidation, just like the October to December, early December period in 2018. And there's the whimper rally, and that's the second leg down, which we saw in the second part of December. So if we look really closely, this was just an epic sell-off. This is Black Thursday, okay, right here. And that's this bar right here. Back it up just a little bit. So this is really the first really bad taste that the market got of the 1929 crash. It was called Black Thursday. So to try to instill confidence in the market, to try to get people to stop selling, Richard Whitney, who is the president of the New York Stock Exchange, and he's also the lead broker for JP Morgan, he marches up to the trading desk and he puts in a very public, for everybody to see, buy order of 25,000 shares of US Steel. And he bids $10 higher than the last bid. So that kind of puts in a little bit of a low. The market closes off the low, as you can see right here. But it doesn't last long. Here's the next day, this little green candle. And then the next day, market starts selling off again. And then we have Black Tuesday right here. So Black Tuesday, the market was down as much as 18.5% down here. It closed the day right here, down 11.7%. Matter of fact, you can see it right there. And then the next day is the 30th of October. And this is John D. Rockefeller Sr. announces that, you know, the sell-off is just crazy. It doesn't make any sense economically, and that him and his son have been buying common shares all through this thing. Gives the market a whole bunch of confidence. And this day, the market was up, or the Dow was up 12.3%. And at that time, it was one of the best days ever for the Dow Jones at that point. And what does the market do? Rallies a little bit. And then you can see the market start selling off again. It's down almost 6% on this day. So what does the New York Stock Exchange do? In an effort to kind of calm investors' nerves, they say we're only going to be open for 3 hours a day of trading this week. But guess what? It doesn't work. And the market sells off again. You can see here down almost 10% the very next day. And the next day after this, November 7th, by like noontime, the market was down like 6%. Okay, so it's just not getting any confidence. It's not getting any traction. So on this day, JP Morgan comes out and they start publicly, again, very publicly, buying stocks, trying to instill confidence. And the market closes up a little bit. You can see 2.63% for the Dow on that day. But does it hold? No. Market starts selling off again. It's making new lows over here. So all these titans of finance, you know, showing their confidence in the economy, their confidence in the market. They're doing everything they can to instill confidence and get the market to move up. Not helping at all. And finally, we get a low and we get a counter trend rally. And if I zoom forward, what happened? The Federal Reserve cut interest rates from 5% to 4.5%, so 50 basis points. That was the catalyst for this 5-month 50% rally. And we can walk forward in that. You'll see kind of looks like an ascending wedge too. This is 50% gain, okay? And it all kicked off right here with the Federal Reserve While we're looking at the Dow 1930, let me show you one other thing that's kind of interesting. This is a weekly chart again, okay? And this is a 50-week moving average. So if I back this up, what you'll see is when the Dow, or the market in general, breaks down, this 50-week moving average tends to get tested on a counter trend rally. Here it is in 1917. Can move forward. Here it is in 1919, 1920 over here. And if we go back to our example from 29, here it is at that example. Fed goes dovish, and we have that counter trend rally up to the 50-week moving average. This is something I pointed out a couple weeks ago. If we look at the S&P 500 with the same 50-week moving average, we see the 2000 top over here, a breakdown in a counter trend rally up to test that 50-day. Here's 2007, 2008 with the breakdown and counter trend rally right here. And up until 2 weeks ago, we had virtually the same picture here. So 2 weeks ago, the S&P looked like this, testing into that 50-week moving average after breaking down. And the last 2 or 3 weeks, it's all been the market's up on trade war, optimism. So this actually does look like another period. Both the 2000 top and the 2007 top came right up to it and turned down. But in 2015 over here, we had a very similar picture. This is 2015. Remember, a weekly chart. Market sells off, and we get a counter trend rally into and above that 50-week moving average. Spends about 3 weeks above it here. This becomes a bull trap, okay, because we have the sell-off, we have the counter trend rally, the market is getting enthusiastic. You got 1, 2, 3, 4, 5, 6 weeks up, and it's sucking in investors, and then kind of chops around in a big volatile range and then goes back and tests the low. So this is kind of a very similar picture here as to what we have right now, which is here. And for very similar reasons as we have seen. Usually it is the Federal Reserve going dovish that gives us these moves. So one last thing I want to show you before I wrap this video up, it's a little bit easier to do it with the video than with charts, is the Nasdaq again, okay? So remember, here's our sell-off, and here is the current rally. Remember, over the last week, for members anyway, I have been talking about the FANGs being down on days they shouldn't be, the FANG stocks. When the broader market is up, or when even the technology sector is up, they've been seeing some selling, I think maybe 3 out of the last 5 days. We can see that here with the S&P 500 in red and green, and an equal weight index of the FANGs in white. So you can see in September here at the market highs, they were making a lower high, and over here between October and early December, as the S&P is kind of consolidating sideways and chopping around, oops, sorry about that, we see they're making lower highs, and they have rallied pretty good with the market over here, and recently they have not been participating. So what I want to point out is this trend line. Now watch, if I take off these trend lines, what do we have? We have an uptrend, right? We have an uptrend over here. I don't know if you remember September, what was going on in September, what I kept pointing out, and it went on the whole month. It was kind of brutal. We had this uptrend, right? I put the trend line back on, and what you could probably see is a break in early September right here, and this is called back testing the trend line. So that is what went on all month. So if I take the trend line off, it just looks like the Nasdaq's up, and that's why it's kind of a brutal thing to be talking about and watching and saying, well, you know, the market's going up and it looks good, it looks bullish, but this is what we call a change in character. So here's the trend with a bunch of reactions, support, support, a break below it, and back testing it that entire month. That's a change in character. That's also where the FANGs were not performing very well. And this is what happens next. So changes in character lead to changes in trends. And this is what happened next. So we have a similar situation going on now. I'm going to tighten this up to a 60-minute chart. And what you'll see is that we have a whole bunch of good reactions here from the December low, 1, 2, 3, 4, 5, about 6. And I can even change this trend line and move it to capture this entire area, but it doesn't capture as many reactions, and it puts the trend line even higher up here and we have even more of a back test. So what happened over the last week, you might remember Wednesday, Thursday, we got some kind of bearish price action. I'll show that to you with the SPY. You'll probably remember this chart. Here's a 2-minute chart of the SPY from last week, holiday shortened week. So here's Tuesday's open, and it was chopping around in this really narrow range. That's about 1/3%. And here we come into Thursday, and this is what I was pointing out early Thursday morning, was this drop in this bearish flag. Now, it's not a big bearish price pattern where everything's broken down, but you can see early Thursday morning I gave some targets for what I thought the next leg down in the afternoon would look like. So here's the first leg, flag, second leg down. This happens to be the same place where the Nasdaq started breaking that trend line. Here it is. So Tuesday, Wednesday breaks down below. You can see it's struggling with it intraday, and it is below it now. So that is where we kind of left off the week. A change in character in that it is backtesting the trend line, much like this. Bigger trend over here, longer period of backtesting, but it is a change in character, which we also saw in the fangs last week. So I'm going to leave it off there. We will pick it up Monday morning. Have a fantastic weekend. Just be careful. I think we're getting really frothy and extended.